This is Quent Bilo with a continuing discussion of managerial accounting. We'll look at some differences between a merchandising and manufacturing company regarding its balance sheet and income statement, and how a cost of goods manufactured calculation is determined. The cost of goods manufactured calculation, which is on its own separate statement, is a key calculation of this chapter. We'll also look at a cost of goods sold calculation, which is much simpler. First, look at the balance sheet. Inventory accounts for a manufacturer are far more complex than a retailer. Manufacturer buys raw materials, inventories it, begins to make production, inventories it in a work in process account, and when it's finished, moves the cost to a finished goods inventory account. This contrasts to a merchandiser, which just shows one category of inventory: merchandise inventory, goods available for sale. The retailer only has one inventory on its balance sheet. It's what the manufacturer sells, finished goods. The retailer will call it merchandise inventory. You see an illustration of a merchandising company on the left, manufacturing company balance sheet on the right as concerns current assets. Current assets for a merchandising company: merchandise inventory, saleable inventory on the left, $400,000. The manufacturer has to buy the raw materials, transform it into a finished goods state, and so three inventories are carried on a manufacturer. More complex. Let's get back to the three elements of cost in a manufacturing plant: direct materials, direct labor, manufacturing overhead. As we recall from a previous talk, the alternative terminology for these product costs are inventoriable costs. So three elements: direct materials, direct labor, and manufacturing overhead, which is all indirect cost: indirect materials, indirect labor, and other indirect costs that are less traceable to the finished product. The essential part of this talk is that we need to see how these cost elements flow through the accounting system. They are all threaded into a work in process inventory account as production begins. The WIP inventory account becomes a key clearinghouse in any cost system. Let's look at a T account overview on the balance sheet. Work in process, again, is the key clearing account. All costs will flow through here. First, all manufacturers accumulate costs as they begin to spend for needed resources. Having a facility in the first place, paying a plant manager, supervisors, etc. These are manufacturing overhead examples. Then buying raw materials, and then paying workers to convert those raw materials. As the production process makes goods, there's a need to assign that spending to the production itself. The spending is moved into the work in process inventory account. All three cost elements are collected in the work in process inventory: direct material, direct labor, and manufacturing overhead. And then, as finished product emerges, completed production costs are transferred to a finished goods inventory account. Work in process can have a beginning balance, costs of work performed on goods not fully completed from the prior period. To that inventory account is added manufacturing costs of the current period. At period end, if there is uncompleted inventory on the floor, we need to assign dollars to that ending inventory value of work in process, inventory not yet done. If we subtract the ending inventory value from the bundle of all manufacturing costs, the rest of all the manufacturing dollars then by default fall out. That gives us a number to remove from the work in process inventory account. This value that we must remove from the work in process inventory account is the cost of goods manufactured, COGM. We'll have a formal statement that calculates this number. As these costs are moved into a finished goods inventory account, they become additions to that account. The subtraction from work in process becomes the addition to finished goods. Now, backing up in our accounting, we first prepare by buying into that account. Beginning balances may already exist for raw materials. All inventory cost flows can be seen through the lens of the base formula. When direct materials are used, the costs are removed from raw material inventory accounts and transferred into the work in process account. This is the S, or subtracted value from raw materials. We use the ending value assigned to remaining raw material inventory to calculate or force out this S value. Assigned costs flow in element by element to work in process as used or applied: direct material, direct labor, and manufacturing overhead. The DM example above is just one of these three elements. It becomes an addition to begin valuing the production that has been started. So the base flow calculation for direct material use becomes embedded in the next inventory account in the plant, work in process inventory. We call this cost progression. Now, a further comment on direct materials. Direct materials flow directly into the work in process inventory account as they are used. These are raw materials directly traceable to the product being made. Any raw material not directly traceable to products being made are called indirect materials, and as used will first be accumulated within a manufacturing overhead category, then later applied into the work in process account as a manufacturing overhead component of cost, along with dozens of other overhead type costs. One more glance at the bigger picture. We want to focus our attention on calculating the cost of goods manufactured value, our COGM value of the cost assigned to completed finished goods inventory. Let's look at a diagram of COGM. First, total manufacturing costs are the sum of direct material costs, direct labor costs, and manufacturing overhead in the current period. This could be a month, a quarter, or a year. When we add the total manufacturing cost to our beginning work in process inventory, when we sum them, we have a total cost of work in process dollars, total dollars available, B plus A in the base formula. Now if we take those sum of dollars total available, at period end they'll either be still on hand or moved on to the next level, cost of goods manufactured. We'll determine the S COGM value by subtracting the E value from B plus A. Here's a look at a complete cost of goods manufactured schedule for current designs. This is for the year ended December 31st. So the period defined here is the complete year. First note that we're starting with the work in process inventory account. This is a cycle of costs for work in process, from beginning to end. Let's start with the first element, the first addition, direct materials used, 146,400. How are these determined? Here we see the first base formula, direct materials. We have a beginning raw materials inventory of January 1st, beginning of the period. To that we add current year purchases and sum those at 169,200, B plus A, the sum of all raw materials available for use during the year. We then assign a value to ending inventory, 22,800, subtract that out, and that determines the amount of goods that we used during the period, used to produce product. So the subtraction from raw materials becomes the new addition to the next inventory, work in process. The next cost element as production is made is direct labor, followed by total manufacturing overhead, 54,800, comprised of the 5 elements shown here: indirect labor, factory repairs, factory utilities, factory depreciation, and factory insurance. Any indirect materials, as applicable, would be included in here as well. The key is that these are all other factory costs other than direct materials, other than direct labor. Let's sum those 3 additions of direct materials used, direct labor incurred, and manufacturing overhead incurred. We get total manufacturing costs for the period, in this case for the year, TMC 376.8. Let's take these additions and look at the beginning work in process inventory of 18.4 and simply add them together. So summing the beginning balance plus all our additions gives the total available dollars in work in process for the period, $395,200. To that sum, we assign a value to work in process ending inventory, December 31st, 25.2. We subtract out that ending inventory to produce our cost of goods manufactured. This is the amount that we're going to subtract from the work in process inventory account. These represent completed goods being moved on to the next stage. Here you can see the base formula, the larger base formula for the work in process inventory account. So two base formulas at work here: raw materials embedded within a larger one, work in process. The base formula that I call it for the flow of costs is going to be very useful in calculating these amounts. Again, the three components are added: direct materials used, direct labor used, and manufacturing overhead applied. All these come into the work in process inventory account. Now, the financial ingredients of work in process inventory, if we know both the beginning and ending values of work in process and can cobble together all the A's or additions, the S subtract from work in process quickly falls out. This is the COGM, the cost of goods completed or finished, cost of goods manufactured. B plus A minus E equals S, the COGM value that we need to remove from the work in process inventory account as goods are completed. When you see beginning and ending inventory values for the raw material account and the work in process inventory account, jump on them. These are the items you need to calculate other values. We do not need finished goods inventory changes in calculating cost of goods manufactured. The finished goods will be analyzed later for a cost of goods sold, their own base calculation. Beginning and ending inventory values for raw materials and work in process will commonly be given. Start here if so. You may need to develop them if other information is given instead, like the subtraction itself, S out of work in process, or the S out of raw material inventory. Be alert to that. Let's do an example, a COGM calculation. The following information is given for Keystone Company. We have a March 1st and a March 31st inventories. In other words, a beginning inventory for March, ending inventory at the end of March. For both raw materials, $12,000 beginning, $10,000 ending, and work in process inventory, $2,500 beginning, $4,000 ending. These are the values we want to quickly latch onto for both raw material inventory and work in process inventory. So in this schedule, we're going to calculate cost of goods manufactured. Again, this is the total cost flow cycle for the work in process inventory. So we'll start with the beginning work in process inventory value, $2,500 as of March 1st. Next, let's look at the base formula for direct materials. Let's calculate how much direct materials are actually used in the production during this month. We start with beginning inventory of raw materials, March 1st, $12,000. We'll add the current month purchases, additions of $90,000. Get a sum of that, B plus A, total raw materials available for use during the period. Now, how much did we actually consume and use up during March? Let's look at our ending inventory for March 31st, raw materials that we assigned $10,000 to. So the difference, or $92,000, must have been the direct materials used up. They're no longer in raw materials, and therefore they are consumed in the production process. That's our first addition to work in process inventory as production begins. Our second element, direct labor used during the month, $75,000 given. Lastly, manufacturing overhead applied during the month, $220,000. So we'll sum those three additions, DM, DL, and manufacturing overhead, $387,000 is our current period manufacturing costs. I'll abbreviate those as TMC, all our additions to work in process during the period. To that, we'll add our beginning inventory of $2,500, summing B plus A. Note that TMC is just the additions. So we have total available dollars of $389,500. How many dollars will be removed from the work in process inventory account? Let's first assign dollars to the ending inventory of work in process. At March 31st, that was given at $4,000. And so we subtract that from our total available cost to arrive at our cost of goods manufactured, $385,500. Let's look at a T account of what we just did. Again, we had beginning work in process, $2,500. We added our three cost elements during the month that totaled $387,000. Ending inventory assigned to $4,000. So by difference, we determined the amount of cost of goods manufactured that we have to remove or subtract from the work in process inventory, $385,500. Here's our math at the bottom. We can see in the B plus A equals S plus E formula, as we simply transpose the E from the right side to the left side, subtracting from both, we isolate the S calculation that we're after, the cost of goods manufactured, $385,500. B plus A minus E equals that which is subtracted from the work in process inventory and moves on to increase our finished goods inventory the next level. Rather than a T account, for those who might want a picture, the work in process inventory is added to by current production as it starts, all TMC costs during the current period. That increases the beginning balance as the glass fills up. How do we calculate the value of the amount completed, or COGM, which is the unknown? We deduct the value of the ending E work in process inventory that still remains. The COGM value is forced out, the completed inventory that moves on to the next stage. So we just calculated COGM. That is a subtraction then out of work in process and becomes an addition to finished goods inventory. Review question. A cost of goods manufactured schedule, COGM, shows beginning and ending inventories for what? For raw materials and work in process only. We need an output number of direct material used from the raw material inventory account. That's the first of three inputs into the work in process inventory. Then the costless cycle from the work in process inventory generates the COGM credit or removal from that work in process inventory. Let's do an exercise on classifying manufacturing costs, our three elements. The illustration here is that we started our own snowboard factory, Diamond Snowboards. Here are some of the costs that our snowboard factory would incur. Let's assign these costs to either direct materials, direct labor, manufacturing overhead, or period costs outside the factory. In other words, not product costs. The first element, material costs. It costs us $30 per snowboard. What's the classification of that item? Direct materials. It's directly traceable to the finished product. Labor cost. It costs us $40 to convert those raw materials into the snowboard. What's the classification of that labor cost? Direct labor, directly associated with the assembly of the finished product. Number three, depreciation on factory equipment, $25,000 per year. What type of cost is that? First of all, it's in the factory, but it's not a direct material, it's not a direct labor, so therefore, by default, it's a manufacturing overhead cost element. Next item, property taxes on the factory building, $6,000 per year. Again, within the factory, not DM, not DL, manufacturing overhead. Advertising costs, $60,000 per year. Now, are we making a product by advertising it? No. That's outside the factory. That'd be classified as a period cost. They'll be expensed as incurred. Not part of the product cost, not inventoried. Sales commissions, $20 per board. Again, is that part of the necessary cost to make it? No. That's a period cost, expensed as incurred. Maintenance salaries for factory facilities. Part of the product or plant manufacturing costs, not DM, not DL, therefore manufacturing overhead by default. The salary of the plant manager, likewise. He's not making the product, he's there to ensure that the factory runs smoothly. Indirect labor, part of manufacturing overhead. The cost of shipping the boards, $8 per board. Now, it's not the cost of making it, but it's the cost of getting it where it has to go to, a period cost, expensed as incurred. So to recap, those costs is classified. We have a material cost of $30 for snowboard, a direct material cost, labor cost, direct labor, depreciation on factory building, property taxes on factory building are both manufacturing overhead. Our advertising and sales commission costs, number 5 and 6, were period costs. They're not part of the plant manufacturing costs. However, salaries for maintenance employees, salary of the plant manager are in the factory, both manufacturing overhead, and the cost of shipping the snowboard is a period cost outside the factory. In the next exercise, we'll ask for a calculation of the total manufacturing cost, TMC, for the year. Since TMC costs are current period manufacturing costs, we need to split out our product costs from our period costs. We do not want any period cost in the next calculation for TMC factory costs. Now, if our company produces 10,000 snowboards during the first year, what would be the total manufacturing cost, total TMC for that year? Let's start with direct materials. $30 a board times 10,000 boards. We'll spend $300,000 on direct materials during the year to make that production. Direct labor, $40 a board times 10,000 boards. We'll spend $400,000 of direct labor for that production. Our depreciation on factory equipment, a fixed cost, $25,000 overhead. Property taxes on the factory building, $6,000 for the year, again, overhead. Maintenance salaries for factory facilities, $45,000. And finally, the salary of the plant manager, $70,000. These are all our costs during the year, total manufacturing costs of that period, $846,000. TMC, factory costs only of the current period. To recap the cost just classified, we were not concerned with 5, 6, and 9. Those are all period costs excluded from total manufacturing costs, excluded from the product costs of the current period. Why? Because period costs are incurred outside the factory. Let's now move to our final inventory account in the factory, finished goods inventory. We saw as we completed product, we increased finished goods inventory with the debit, the COGM dollars. Now as we sell finished goods inventory, we'll remove them from that account through a cost of goods sold calculation, taking them out of finished goods inventory and putting them to a cost of goods sold account, which is an expense account on the income statement. This is a much simpler calculation. So moving to the income statement, again, we're moving finished goods inventory product costs out of the balance sheet. Under a periodic inventory system, the income statements of a merchandiser and a manufacturer differ in the cost of goods sold section. Again, for cost of goods sold, we're talking about sale of a product that's no longer available. It's been sold to a customer. The cost of goods sold components are shown below. Under a periodic inventory system, that just simply means that we calculate cost of goods sold only periodically at month end. The merchandiser purchases their finished goods. The manufacturer makes the goods that they sell. Effectively, the merchandiser is buying from the manufacturer. In these components, though, we see both have a beginning inventory, both have additions to that beginning inventory, and both assign values to ending inventory. If we subtract out that ending inventory value, we'll arrive at a cost of goods sold. That is, both the merchandiser and the manufacturer, to calculate cost of goods sold, are using the base formula. B plus A minus costs assigned to ending inventory forces out the cost of goods sold that must be removed from the respective inventories. The merchandiser calls their saleable product merchandise inventory, the manufacturer finished goods inventory. Here we see a partial income statement for a merchandising company on the left, a manufacturing company on the right. For the merchandiser, the additions to their merchandise inventory are purchased. For a manufacturer, they are manufactured, more complex. We saw that COGM was developed in a formal statement back in the work in process inventory account. Now the cost of goods sold calculation, COGS, is much simpler, the cost flow cycle of the finished goods inventory only. So let's look at the base formula for calculating cost of goods sold. Again, the finished goods inventory account only. So calculating cost of goods sold, our review question years for the red company, they have the following elements. Cost of goods manufactured of $600,000. This is the A, the addition to finished goods. Their beginning finished goods inventory was $200,000, and their ending finished goods inventory was $250,000. What is the cost of goods sold? We're looking for the S in the finished goods inventory account. So we start with the beginning balance of finished goods, $200,000. To that beginning value, we add our cost of goods manufactured, $600,000 during the period. We'll sum that, B plus A. Total finished goods available for sale, $800,000. If we have a ending balance in finished goods of $250,000, that means we've sold the difference, or $550,000. Cost of goods sold. Developed last. Again, looking at a T account, the calculation of cost of goods sold is much simpler than COGM because the finished goods inventory is dealing with a single bundle of costs going into it. Not three additions, only finished goods, $600,000. Our math at the bottom. What's our cost of goods sold for the period? Beginning $200,000 plus additions of $600,000 completed goods during the period. Subtracting out our ending inventory of $250,000 remaining means we sold $550,000. That value increases our cost of goods sold account on the income statement. The textbook comments on trends in managerial accounting, which impacts how information is used in a business. In the last few decades, emphasis has been given to all of the business processes that are associated to providing goods or services. This is called the value chain. This requires looking deeper beyond the activities we just visited in acquiring raw materials, converting them, and selling the finished goods. Why? All facets of the entire process can ultimately affect the satisfaction of the customer. Research leads to how products are designed. Design affects the cost and complexity of the production process itself. The location of manufacturing facilities or warehouses affects the timeliness of customer deliveries and ultimately customer satisfaction. Technological changes have had large impacts on the value chain. For example, ERP software systems, enterprise resource planning systems can provide efficient and integrated source of information to allow more informed management decisions today.